Good morning, everyone. Thank you for being so patient with us while we waited for, folks to log in. Seems like we're still getting some active login, so we will let that continue while we go ahead and get started, to be respectful of time. Good morning. My name is Sandra Delancey. I am the moderator for today's webinar entitled Real Estate Investing During a Recession. We have muted your audio, but we will still allow for questions. So if you have questions for our presenters, send them to me using the question feature of GoToWebinar. We also will answer questions during the webinar as well as at the end. And if there are any unanswered questions at the end, we will have Sam and Charlie to respond via email. The presenters have also made the slides available in the handout section of the GoToWebinar. So you will see this whole PDF or the whole slide presentation in a PDF file and handouts. I am excited to present two DMV real estate leaders who are also business partners at Clear Sky Financial, LLC. Charlie Einsman has more than 20 years of real estate experience and is particularly skilled in structuring and negotiating win-win solutions for distressed sales. Along with Sam Jackman, Charlie co-founded Clear Sky Properties, LLC in 2005 and Clear Sky Financial, LLC in 2013. He primarily takes the lead for networking, sourcing new opportunities, and negotiating new deals. Charlie is a licensed realtor in Virginia and has a Bachelor of Science in Electrical Engineering from DeVry University or DeVry Institute of Technology. Sam has more than 25 years of experience in a broad range of real estate endeavors, particularly with distressed property sales and development. He primarily takes the lead for loan closing and administration duties for Clear Sky Financial, while he and Charlie collaborate on prospective deals. Sam also owns and is the principal broker for Green Dot Realty, is a licensed realtor in Virginia, DC, and Maryland. He earned his Bachelor of Science degree in anthropology and an MBA in finance and marketing from George Mason University. Take it away, Sam.
Thanks, Sandra. And thank you everybody for joining us this morning. We have a very much changed real estate environment in the last couple of months since COVID has come about. And we've moved into a recessionary environment by all measures. So whether it's a recession or growing into a depression, we're not quite sure, but we do know that we've been through difficult times in 2008 previously, and while this is quite a lot different than that there are going to be really material impacts to the real estate market right now. So Charlie and I have been working to change and adjust our business strategies to match the environment, and we did that the last time in 2008. We're going to continue to progress to do that in this current situation. So right now, there are some similarities with 2008. The stock market's off materially. The economy has lost a lot of jobs, but underlying the housing market is a totally different situation that we will need to take a look at. And in 2008, we had a situation where a lot of homeowners, a lot of investors had taken on debt that they couldn't service. The debt was changing and at changing terms, exploding interest rates and so forth. And then the market went down maybe 45% in areas of the Northern Virginia, DC region. And that was really material. Here we're seeing just a complete change in the real estate market. People can't go and show homes. We're not sure about underlying demand, and we're out there still looking for opportunities. I'll let Charlie speak to some of these changes that we're looking at between the prior recessionary environment and what we're coming into now.
Okay, good morning, everybody. What we have to understand is that this market cycle is a lot different than the 2008, 2009 market cycle. In this current market cycle, we're experiencing a lot more job loss. The job numbers are much higher today than they were back in 8 and 9. In this environment today, interest rates are much lower than they were back in 8 and 9. Different sectors of the economy were impacted in 8 and 9 as compared to today. And so what does that mean for us for today? We have something called the Clear Sky model. And so in our case, we have 2 different companies that we're dealing with in this horizon, we have our company called Clear Sky Financial, and we have a company called Clear Sky Properties. Clear Sky Financial is our hard money company that lends out to private investors. We do fix and flip loans, we do buy and hold loans, we do transactional funding loans, we do cross-collateralized loans. We basically do loans for the investor in the investor space. And one of the things that we're doing in this environment is we're lending money. We're one of the few private lenders that are actually lending money into this environment. And one of the reasons why we're still lending money into this environment is because of our experiences with 2008. We've undergone a recessionary period, and so we feel comfortable that we are able to evaluate assets. We're being a little bit more conservative, but we feel that we have the strength to lend into this environment. Now, one of the things that you have to understand is what is going on with our competitors in the hard money space. And what's going on with our competitors is that a lot of our competitors were reliant on Wall Street money, which comprised of hedge fund money, other assortment of fund monies. They were also relying on what's called crowdfunding monies, the crowdfunding model. And so what's happened is in the last 6 weeks, these funding sources have completely dried up. The other thing that's impacting our business on the hard money side is that we have had other hard money lenders actually go out of business. Pre-COVID, there were a lot of our competitors that were struggling financially, and so they were in the process of going out of business. So what does this mean for everybody out there who's trying to borrow money on the hard money side is that there are much fewer competitors and much fewer sources out there. And so that's going to be a little bit more challenging for you on the investor side if you're trying to do fix and flips, because what you're going to realize is that you're going to have to put more money into each deal. So each deal is going to have to be a little bit more capitalized by the borrower. And the other thing that you're going to be absolutely shocked about is that the expenses or the fees that you were paying in the past, don't be surprised if they go up a little bit. The reason why they're going up is because you have to understand the underlying hard money companies like ourselves that are still in business and doing loans, we have to sort of mitigate our risk a little bit more. So it's going to be a little bit more expensive on the lending side, but if you guys are getting really, really good deals, you still want to go down the hard money path. Now, the other thing that we're doing on the hard money side is that we're modifying some of our parameters. So one of the parameters that we use is called LTV over the ARV. What that means is that LTV simply stands for loan to value, and ARV is the after repair value of an asset. We have always been an asset-based lender, and we have always lent on what was considered the after repair value. Now, let's say back in January, we were lending out at, I don't know, 75% of the after repair value. So if I had let's say a house that was worth $400,000, we felt comfortable lending $300,000, which is 75% of the after repair value. Now what we're doing is we're just consolidating those a little bit. So we might be lending maybe 70% of the after repair value, but we're still using the after repair value as one of our indicators and one of our lending parameters. Now, the next lending parameter that we use is this thing called loan to cost. Now, a loan to cost is basically the purchase price of your project plus the renovation. So let's say, for example, you have a $170,000 purchase, you have a $30,000 renovation. Well, the total cost is $200,000. So what we were doing is lending 95 to 100% of the LTC, as long as it met my loan to value of the after repair value parameter. So where we were lending 95 to 100% of the loan to cost, now we've dialed it back and we're lending between 85 to 90% of the loan to cost. Again, we're still lending, and so we're still being kind of aggressive in this environment compared to all of our other competitors, but you guys can be safe assured that if I like a deal or if we like a deal, we're going to fund it. And we can fund very quickly. You know, one of the things that we rely on is title companies to pull the title to do the title search and the title abstract. But the big thing is, though, is these title companies are having a little bit more delay on getting those title abstract pulled. So your deal's probably going to be delayed a little bit, but that's okay. But hang in there, and you know, we'll close this thing as fast as we can. But again, we are still lending on the Clear Sky Financial side. Now, the next company that I want to talk about is Clear Sky Properties. Clear Sky Properties is our holding company where we do two things within Clear Sky Properties. We have a fix and flip business, and we have a buy and hold portfolio. Our buy and hold portfolio, we have quite a few rentals. We're up close to 50 rentals, and we manage these things through Propertyware, but we got quite a few rentals that we're managing as well. Now, the next thing that Clear Sky Property does is we buy fix and flips. We flip between 2 and 3 houses a month. We're continuing to do that today. We are continuing to buy. Now, what is Clear Sky Properties doing? Number one, we are completing all of our renovations today on all of our fix and flip properties. We have a bunch of fix and flips in the queue. We are getting these properties to market. We're keeping our workers employed. We're keeping them very, very busy. We probably have a need for another contractor or two, but that's just the way it goes. But we are keeping our workers busy, and we are getting our current projects to the market as we speak. Now, we also have a condo conversion going in Trinidad on Staples Street. That project's going to hit the market in about end of May. And so we're getting that on the market as well. And so one of the things that we're doing, though, is that if some of our projects aren't moving as far as selling, we're just simply turning them into rentals. And so one of the things that you have to do as investors is that if you're looking to buy a fix and flip, you've got to have plan B, which says, what happens if my fix and flip doesn't sell? Well, you're probably gonna have to turn that into a rental. And we're actually doing that to this day on a couple of projects in Washington, D.C. that are not entry-level projects. And so what are we doing with our long-term holds? Obviously, we're getting those guys fully rented out, and we're getting those things maintenance ready. So if our tenants have any maintenance issues, we're making sure that we get those guys completed, because one of the things that we want to do is especially in this period, just like anything else, is we want to keep our tenants happy. And so we're very cognizant of our tenants, and we want to keep those guys happy. And so that's basically what we're doing on both companies. But again, we're still very, very active in this marketplace, and we're still lending under Clear Sky Financial, and we are still buying under Clear Sky Properties. And so the next thing that we'll do is we'll talk about managing your real estate investing risks.
Thanks. And now looking at the management of real estate investment risk, we're trying to understand how we can make some money in the current environment. What constitutes a good buy? So in order to know that, you're going to have to take a look at all of the risks in the marketplace and figure out if you've got a unique situation for a buy opportunity where the risk is the seller is ready to make a move, and it's going to be an excellent economic value. And so you have to look at the general risk, what's short term. You're thinking about consumer fear, about the COVID, about going out, about investors acquiring properties in this environment, and that is going to certainly be with us in the short term, but may not represent the overall market. So if there's some component of it that's just short-term pricing changes related to COVID, you can look at that. Then you start thinking about the physical property. How is the person going to get into the property? We're trying to break down how much of any price adjustments are related to these things. So if a person can't show a house because it's occupied, or the occupant needs to stay there a couple months because they can't move, does this present an opportunity for you as an investor, and an opportunity for the seller to go ahead and collect the money that they need now, move out later, or something like that? Then we look at how's the competition doing, and where are we going to get our capital? Like in terms of paying for the property, what is going to happen next? Are we going to go to a local community bank and wait 45 days, 30 or 45 days to our closing? That's possible. Maybe that'll work. But more likely, you need money with immediacy to present a value to a seller, and that's where hard money lenders like Clear Sky Financial come in play. And you can look to us to support you in the process and do that very quickly. Then how are you going to get to closing? You found a property, you think it's a really good value, it's priced well below the market. Say the market you're thinking is going to go down 10%, maybe even 15%, but you found a property that's down 40% because the person simply had highly motivated to liquidate it and move. So how are you going to get to closing? This is like a very critical thing. Not every title company is able to do a virtual closing. Not many of them can. And so are you going to have to go to a closing? Is the seller going to have to go to a closing? Is the seller out of state? Do they need to be notarized with an on-site notary going to their property? Just the coordination of the closing can become a very big deal. And because the seller may or may not have access to go out, not every title company is prepared to work with them. So you have to work with your title company to make sure that there's a way for everyone to get to closing. Once you get the property, you need to manage the contractor resources in light of the current environment, right? There's all kinds of impacts on the contractors. One is that they're spending a lot of time in line at their building supply companies. That's slowing projects down enormously. Some supplies are in limited supply because of the distribution of those. And it's very critical to understand your timeline on when you're going to find an asset, you're going to improve the asset. You want to know when you're going to sell it. So how does that fit in? The contractor's work fit into that timeline. And then you get to the final disposition of the asset. So we're going to probably be in a COVID environment for quite a while where people are reluctant to go out and meet with one another. But if you've got a vacant house to sell, that could be a real opportunity. You could use marketing techniques that you haven't used before. We've been using 3D picture tours. They're extremely effective. People can go through the properties virtually, and then with the property being empty, you can give them a self-guided showing of the house, or their realtor can make an arrangement for something like that. So we're trying to understand where you are in this process as well. We're going to do a poll. This is like an electronic survey poll that Sandra is going to introduce to us, and that'll allow us to speak a little bit more directly to you, because we know that the audio is cut off for the participants. So Sandra,
Hi, everyone. So what you're going to see, can you hear me, Sam?
yes.
So you'll see on your screen shortly a poll, and you will have about 30 seconds to answer the poll. We'll take the results of that, and then Sam will speak to it after. So we have two polls for today's session. The first one that we're looking at is, what is your current real estate investment profile? We're going to introduce a concept of, surviving to thriving, in a couple of slides, but we want to know, what your posture is right now with your real estate investing. So here's the poll. I'm going to launch it. So if we can take 30 seconds for you guys to, answer the poll question, we'll collect the results and get that back to Sam. The polls are anonymous. We don't see who is submitting what. We just see the summarized view of it. So let us know, what your investment profile is. Okay. Okay. I've heard that a couple of people are having a problem clicking on the poll, but others are, clicking just fine.
All right. You think we can see the results?
Let's take a look at that. Let's see poll. So we have 74% who have voted. Let's see. All right, we have about 28% that are survivors, Sam. 24% are planners. 24% are thrivers, and then 23% are not currently investing. So right now the numbers are ticking up a bit. About 28% are survivors. So we have mostly survivors here that are looking to earn extra income and learn. So
Okay, great.
thank you.
So this will be an educational focus here today on what we're doing and what you can do in the marketplace. So when we're thinking about how we move forward uh, day to day, we look at the very most current information on the market. We look at the houses that are available in the marketplace, and we look at the people who are bringing us transactions and one that we're going out to reach if we're touching base with wholesalers and sellers and people we've sent mailers to or people we've been in touch with previously who had an interest in selling but wasn't quite sure. So we're thinking about where we are today. We're not worried with where the market was or how successful we were yesterday on yesterday's strategy, but we're really looking at how to find those buy opportunities today that will make good long-term holds, or where we can buy a property and keep a person in the property that needs to sell it and then they can rent it back, or whatever individual solution. We're getting to very individualized solutions in response to the market. So we're doing that relentlessly every day, driving through it, and we're having a lot of success. We're finding good buys, and we're supporting our team of employees and contractors, and they appreciate it, and they're working hard to continue to expand the business, or at least stay in place while other people are just falling back behind because they're not working as hard as they possibly can to move through this environment. You just can't wait for something to happen. You have to be in an active mood. Now that may mean that you're not taking a specific action that day, but it's still not waiting. You're evaluating, you're positioning yourself, you're readying your systems, you're supporting your team. So we're looking at our relative position to where we've been and where we're going. We're not in the same mode of setting long-term goals today. We're in a more of a responsive mode. So if we go to the next slide, we're going to talk.
Hey, Sam,
Yes.
I'm going to stop you for a minute. I want to let folks, know that they can ask questions to you directly or to me, and I'll, pose them to you by using the question feature of GoToWebinar. But we do have a couple of questions, or at least one that we can talk to right now. What are you
Sure.
seeing in the rental market now? Are things renting? Are rent rates down? How's the rental market looking right now for someone who wants to, get into real estate investing and looking to rent out properties?
Oh, that's a good question. Yeah, the rental market is very strong right now. We've had a few assets that we went ahead and put on the market to rent out. We've been very successful in getting qualified candidates, especially in like a vacant one. That goes very easily. We're having some additional success. We're just getting possession of a property today, and even on the very first day before we've turned it over, we've got people looking at it to rent it. So that's going quite well. I don't think that you're going to see a downward trend in rental prices or in rental demand in this market. If anything, that will be a little similar to 08, where there was plenty of rental demand because people did need to, live in a place. You got to live somewhere, and then you can work with folks that have employment and can define how they're going to make payments on their rent. So I think we're strong there. What do you think, Charlie?
Yeah, I agree. The rental market is very robust and strong. The actual rents themselves are not going anywhere. But one of the keys, though, in the rental market is, though, you've got to be really, really cognizant if you're getting new tenants to, obviously, you're checking their income. But see, for us, it's more important that we check the sources of income because what's going on is there's a lot of job loss out there. The majority of the job loss is because of service-oriented employees. And so for us on the rental side, we're just being very, very cautious on who we rent to. And so we might keep a property out there vacant for a few more weeks, be a little bit more picky on the tenant. But as far as the actual people needing rentals, remember, guys, people are always going to need a place to live. No matter what the economy, they're going to need a place to live. So we're seeing a strong demand for newer rental product, as well as the rents themselves. I haven't seen any wavering in them at all. As a matter of fact, rents have been very, very steady the last 3 or 4 years. As a matter of fact, prices have gone up, rents have stayed steady, and in some cases, rents have come down a little bit. So because of the long-term steadiness of the rents, we don't even see a change in rents in the near future. But what we need to do is just be a little more picky on the tenants that we select. Okay.
Thanks. Yeah. Thanks, Sandra. So we're going to talk
Okay.
next about understanding the real estate
All right.
markets.
Yeah, and so what you have to understand is that there's two different markets out there. There's a business market cycle, and then there's a real estate market cycle. But before I start talking about the real estate market cycle, I just want to touch a few points on that poll you guys took. There are obviously 4 different levels that we see in real estate investing. And what you have to understand, and there it is right there. Go back, Sandra, one more chart where you are. Us, Clear Sky Properties and Clear Sky Financials, we can help you guys on all 4 phases. If you guys are beginning real estate investors, it's okay. That's what we're here for. If you're doing your first fix and flip, we are more than happy to help you out. If you've never currently invested in real estate and you want to get into it, we have upcoming a new educational series that will help what we're calling the not currently investing category along with the survivors. So we have a big education plan that we're actually working on right now. We have a lot of modules for the rookies and the people who don't know anything about it. And that's okay. We've been there. We've been in your shoes. We have been those guys who've never invested before. And so, you know, we can help you there. As a survivor, we can help you there as well. We understand what it's like to own no properties, to go ahead and buy our first, you know, owner occupied residence, what it's like to put a HELOC on top of a property, maybe to help you go get your first rental property. We know what it's like to own 1 or 2 rental properties. And then as you grow further into your investing career and you go into the planner phase and you acquire a few more rentals and you start doing a fix or flip, we've been there, we've done it. We know exactly what it takes to grow those types of your businesses. And now, if you're a thriver currently and you might own your business, you might have 10 or 20 rentals, you know, and you want to get into another space, like maybe buy distressed second trust or something like that. You want to branch into tax lien certificate investing, or you want to go ahead and grow your hard money platform. We're there for you as well. We have done all this stuff. So currently we're at obviously the thriver level, but we can help people under all 4 scenarios. And it doesn't surprise me that if you take our seminar and you take a pie in the chart of our seminar, that roughly 25% of you guys fit all these categories. And again, we can help in all these single categories because we've been here, we've done that. Now, I'm going to segue into understanding the real estate market cycle, because when we're in this situation, one of the things that you guys have got to understand is you've got to understand the real estate market cycle. Remember what I said earlier is that there's 2 different cycles going on. There's a business cycle, and then there's a real estate market cycle. On the business cycle, it's basically the stock market. But remember, though, the stock market is basically a 6 to 9 month future prediction of what's going to happen in the business. So right now we have huge unemployment. Stocks are going crazy. They're going up, they're going down, they're going up, they're going down. Nobody really knows what's going on in the stock market and the business cycle. Because of the job numbers, we're certainly in this thing called a recessionary environment. I've heard some people use the D word. I've heard them use the D word, which stands for depression. We won't know if we're actually in a depression, maybe till another year or 2 from now. So now let's talk about the real estate market cycle. The first phase of the real estate market cycle is what's called the bottom. The bottom of the market happened in Virginia in 2008, 2009. And so this is basically where prices bottom out. Normal consumers are not, they don't have any confidence in the market. Interest rates might be high, prices are at the bottom, but just like anything else, we can't predict the bottom. There's excess inventory, deals are plentiful, cash is at an all-time high, but the market is at a bottom. And so that's kind of what the bottom is. The next segment of the real estate market cycle is called the climb. What happens in the climb is that confidence improves among homebuyers, and this leads to more sales. Remember, though, the investors are the ones that kicked us out of the bottom, and so you have normal consumers coming back into the marketplace. Inventory starting to decrease, and prices are starting to either climb a little bit or they peaked out from their bottom. So that's kind of what a climb is. And then, of course, after the climb, this leads to what's called the peak of the market. And obviously, the peak is exactly what it stands for. It is where prices are at an all-time high, inventory's down, and then multiple offers come in on certain properties. And guess what, guys? We have been at our peak for quite a long time. November, December, January, we were at a peak. As a matter of fact, 6 months ago, we were very, very cautious. We started being cautious 6 to 9 months ago because we felt the market was maybe not at a peak, but it was getting very close to a peak. And so we sort of started getting more conservative 6 to 9 months ago. Now, let's fast forward this to February and March with the COVID environment, right? The COVID environment certainly defined the peak. But what's going on though is that in certain sectors, we are still kind of at that peak because we're still seeing multiple contracts on entry-level properties. If there's a good vacant property that has a nice 3D tour that is priced really, really well and it shows really, really well, that property might get multiple contracts. So we are coming off the peak. So we're in this position between a peak and what's called the tipping point. And so right now, we are at the tipping point. Now, what happens during the tipping point? Prices begin to fall. There's compensating for the overbuilding. There's compensating for some of the high prices. So right now, if you look at the peak and you look at the tipping point, we are somewhere in between that right now. I can't tell you exactly where we are. We might be in the middle, but we are certainly closer to this thing called the tipping point. Now, the next part of the cycle obviously is the decline. And what's going to happen is that prices are going to continue to fall. The reason why prices are going to continue to fall is because there's going to be more inventory hitting the market and less demand. Now, what we're currently seeing is that that's not the case right now with entry-level properties. Now, an entry-level property is defined by where you live and how far out from the city you're in. Now, what we're talking about and we're focused on in our area is called the DC, Maryland, Virginia market. So when I'm speaking to this, I'm speaking to the DC, Maryland, Virginia market. And so one of the things that we're seeing is that entry-level properties right now in our area are very, very hot. Why are entry-level properties hot? They're hot because interest rates are really, really low. And so if you're a good borrower, that means you can purchase a good entry-level property and you can get in there for cheaper than rent. Your mortgage payment will be cheaper than what your rent is going to be. And oh, by the way, you're going to get some interest write-off on that mortgage. So we really haven't jumped off the peak in some areas, but some areas we have. Now, in certain higher priced areas, we're seeing a lot of price pressures. There's a lot of building inventory. Again, depending upon where you are in the area, there's building inventory and there's a lot of price pressures. And so in our case, in our experience is that with the higher dollar properties, we've had a couple assets in that asset class. We haven't been able to sell them. We can certainly sell them if we decide to drop our price, but we said, oh no, we're not doing that. So what we've done is we turned those higher priced properties into rentals. Now, we wouldn't have done that under normal circumstances because we want to sell those properties and we want to get our cash back so we can reinvest it. But in this case, with those higher dollar properties, we've had to turn them into rentals. And that's already. And so now we're between the tipping point and the decline. Now, basically, like I said, the decline is where foreclosures flood the market. Now, what's going to happen in this COVID environment? Well, one of the things that we're going to start seeing is people are going to be obviously late on their mortgages because they got laid off. But what's going to end up happening is you're going to have two very powerful forces that are going to happen in the next 3 to 6 months. The number one force is that the government is going to help somehow. Whether the government helps Wall Street like they helped Wall Street back in the 2008, 2009, we don't know. They're starting to help Wall Street out. But what we're seeing is that the government hopefully is going to help out Main Street. Main Street is you and I. And so that's a big, powerful force that you've got to keep an eye on. The next powerful force that you got to keep an eye on are the foreclosures. Now, what's going to end up happening is that these big mortgage companies, these big servicers, what they're going to do is they're going to enter into what's called a forbearance environment. What a forbearance is where you add on the payments to the back end of the loan. So let's say this COVID lasts, I don't know, 6 months. Let's say it lasts 3 months. Let's say it lasts a year. And out of that year, you might miss 3 or 4 payments. Well, the number one thing that mortgage companies are going to do is they're going to add those payments on to the end of your loan in what's called a forbearance. So it's really hard to tell what's going to happen between the tipping point and the decline. What we think is going to happen is that it's just going to be a little bit longer scenario. Whereas maybe between the tipping point and the decline, it might have been, I don't know, 6 months to a year. Well, it might be a year to 2 years to 3 years. But But with these powerful forces, though, you've got to keep an eye on them. And the next thing that you've got to keep an eye on in this COVID environment is you've got to keep an eye on the number of new COVID cases, because we might get a second iteration of COVID, we might get a third wave. So what's happening is that this is here to stay for at least another year, year and a half. So we just have got to learn how to do business in this marketplace. And so the next thing that I'll talk about is what happens in real estate during a recessionary environment. So we'll move on to the next slide, which talks about that. Yeah, I'm sorry, Sandra, go to the next one.
Charlie, can you hear me?
Yes, I can. I can't see the next slide. Is it up?
I am trying to get through the technical difficulties we're having here with millions of kids being at home and homeschooling, so I'm a little bit slow. I'm trying to catch up with you.
Okay, I apologize. All right, guys. So
Okay, here I
the
am.
next couple slides, we'll talk about why you are here. Okay, you've heard a lot of information from Sam and myself about what's going on and how to try and understand this moving market. The first thing, there's 3 ways that real estate investments make money during a recession, during a depression, during a peak in the market, during a bull market, during anything. So you have to understand each way that real estate investments make money. The first thing are loans, which you have to understand, whether it's a loan from a private lender, whether it's a loan from a mortgage company, even whether it's a credit card loan. These companies still make money on interest from the loans. And so whether you miss payments here or there, you're still going to end up having to pay back the principal, and that principal is going to have interest associated with it. So what you have to understand, real estate investments on the loan side the loans will still continue to pay interest even during a recession or a depression. So that's number one. The second thing that you have to understand is that if you have rental properties, I'm just talking from the real estate, from the residential standpoint. We can get into commercial too if you want, but from the residential standpoint, renters will and have to continue paying rent even during a recession. And so if a renter misses a couple of payments, what we do is that let's say they miss 3 rent payments or something because they lost jobs, we'll help them get them on their feet. But instead of once they get back on their feet and they get their job, we'll just spread those 3 missed payments over the term of the lease and put them on a payment plan. They'll pay their current rent and then they'll just pay us back over a period of time. So, but renters still continue to pay rent. Now, the third thing, and the most important thing, well, not the most important thing, but the third thing is that you have to understand this thing called appreciation/depreciation. Properties may not be appreciating during a recession. Okay, we all know this. They're probably going to come down in value. However, this is a great time to pick up more real estate. Whether you're going to fix and flip, you're going to get better value points. Whether you're going to buy and hold, you're going to get better value points, which is going to come into another topic that I'm going to talk about on the next slide, which is going to do the 1% rule. So there are a lot of opportunities right now to pick up properties with a little bit of equity in them. And so you've got this thing called appreciation. So this is one of the things that if you're really into real estate investing, especially on the residential side, this is sort of the market change that we needed, because between 2008-ish, 9-ish in Virginia, we've been on an uptick. We've been on a 10 or 11 year uptick as far as pricing. Maryland, DC, they had a 5-year foreclosure moratorium. Their uptick didn't start until maybe 11 or 12 because they took more time to get the foreclosures through their system. Now, the DC, Maryland foreclosures are still not totally through their system yet, but this is a great opportunity to buy. And so we're very not bullish, but we're looking for values right now. This is what we're buying on. We're looking for values. We purchased 4 or 5 houses in the last 3 or 4 weeks. And so we're purchasing with value in mind, and we're purchasing with buy and holds in mind, which leads me to the next slide, which is another important slide. Okay.
Hey, Charlie,
Yes, ma'am.
before you move on, we had a question around, I guess, rental payments and paying mortgages. So if you're a real estate investor, if I'm a real estate investor and my renters aren't paying me, their mortgage, or they're paying me their rent, we heard you say that, you can actually defer it or forbear it. Are there any programs like COVID programs, like from the government, that might give you some assistance during this time?
That is a great question. We have not seen any rental assistance program at the consumer level from the government as of yet. Some of the government programs that are out there are this PPP, Payment Protection Plan, which is helping small businesses. But as far as Main Street, the only thing that I've seen right now to help Main Street is the $1,200 that they're handing out. But let's be real, guys, that $1,200 isn't going to pay anybody's rent. It's going to pay your food, right? So if you're unemployed, it's going to pay food.
If you have a mortgage, you can defer the mortgage payment.
Yeah, so let's talk about two things. So number
But I'm
one,
not certain that applies to investor mortgages.
yeah, so let's talk about rents, right? Let's say folks can't pay their rent. Well, normal landlords like us, what we're going to do is obviously defer rents as much as we can. And so what we're going to do though is, let's say they can't pay rent for 3 months. We're going to make an agreement that says, all right, you can't pay rent for 3 months. If it's a $2,000 rent payment, you owe us $6,000. Well, if your lease is a year and you've got another 9 months on it, we're going to spread that $6,000 over 9 months while you're continuing to pay your current rent. Now, obviously the courthouses are closed. We can't do evictions as of yet, but eventually there has to be a breaking point where either you are
I have lost Charlie's signal.
I've also lost Charlie's signal. Sam, can you hear me? I think we have Charlie.
am I back?
You're back.
All right, I'm back. All right, I'm sorry, guys. Where did they leave? That's all right. Let's just go back to the renters for now. If the renters are late, if they're late 3 months, we add that $6,000 across the term of the lease. But the most important thing, though, is that you have to have a communication going between tenant landlords. One of the things that we understand is that not only is it a business relationship, it's also a personal relationship. We want our tenants to be happy with us. We want to be happy with our tenants. Now, how are tenants happy with us? When tenants have a problem with their property and maintenance issue, we have a guy there the next day. And so we want our tenants to be happy with us. So as long as the communication channels are there, we're okay with it. We're not totally okay with it, but we're okay with it because we have to be. Now, one of the things that we do is that with our tenants, like I said, we keep the communication channels going. And so that seems to be very successful. And so the next thing I want to address are the mortgage payments. Now, what you have to understand are there's two different kinds of mortgages. There's a consumer mortgage, which the most of you guys have, and then there's an investment mortgage, which is us on the hard money side. Let's touch base with the consumer mortgage. What's going to happen is if you miss a couple of your payments, again, you've got to keep the communication chains open between you and your bank. And so what they'll agree to do is they'll agree to do a forbearance. Basically, a forbearance is an agreement to add the missed payments onto the end of your mortgage. But again, this is only going to go over a certain period of time. There's going to be a tipping point under that scenario. Now, with us on the hard money side or the private lending side, if you're going to miss your payments with us, we're going to do one of two things. We're either going to add it to the end, which means when you flip your property, we're just going to get it's going to be a little bit of an increased payoff, but we're going to keep receiving our interest. And so again, communication channels have got to be open. We've had a couple people already miss their payments. Now, the other thing that we're going to do is we just need to make sure that your project is on track. Because let's say we have, 80 or 90 loans. Well, 90% of those loans are fix and flips. So for us as a hard money lender, if we promised you certain draws, then what we're going to do is we're going to continue to do the draws to make sure that your project is on time, on budget, and gets to the market, because we want your projects to the market. That's the most important thing. We're going to help you along those lines. But if you're a payment or two behind, okay, that's one thing. But if you're 3 or 4 payments behind, then we're going to take 1 or 2 of those payments out of your draws. And so we're going to short you a little bit, but we're going to make sure that we catch you up on the payment cycle and we get you closer to your draws. So remember, there's 2 things. There's a mortgage and there's a normal consumer mortgage, and then there's our private loans. Okay. So now,
All right, thank you, Charlie.
the next chart is going to show keys to investing during a recession. And this is very, very important because this is exactly what we are doing. And so you guys have got to keep an open mind to what we're doing. Now, obviously, this isn't the end all be all, but for us, we've done this before, 2008, 2009, 2010. This is what we're doing today. The only difference is now we have a hard money company. We didn't back then. Now, first thing that we're doing is we are preserving our own assets. What does that mean? Again, I talked about this earlier. We're getting our fix and flips on the market. We're getting our condo conversion on the market. We're getting them ready to go. So on the buy and holds, any maintenance that needs to be done, we're getting that done. So number one, we are preserving our own assets. Now, the second thing that we're doing is that we are very aggressive into this marketplace. We are purchasing buy and hold properties that meet the 1% rule to put into our rental portfolio. What does that mean? Well, I'll keep it simple. If the rents are $2,000 a month, then I want to purchase that property at $200,000. I want my purchase price and my renovation price, which is a rental renovation, to be somewhere in the $200,000 number. If it's between 180 and 220, that's fine. I just use that $200,000 as a barometer or a parameter to tell us that we think we probably need to keep this property in our portfolio. So that's a very important tool to use. It's called either the 1% rule, take the price, divide it, or it's the 100 times rents rule. Either way, that's what we're doing. We're very aggressively buying. Like I said, we've bought 5 properties in the last couple of weeks. 3 of those properties we're putting in our rental portfolio. The next thing that we're doing is that we are purchasing at value points within the fix and flip market. Now, one of the beautiful things that's happened with this downturn or this upcoming downturn is that it's flushed a lot of people out of this space. The wholesalers are starting to come to terms a little bit better. They're not being as greedy as they were. The wholesale fees are coming down, which we appreciate because we want to deal with wholesalers. We just don't want to pay $50,000, $60,000, $70,000 wholesale fees. And so we're seeing these fees come down. The next thing that we're seeing is that we're starting to see a little bit more distressed sellers coming on the market. There's certain people that still remember they have to sell their house because they want to move. They have to move, but they transfer. So we're starting to see a little bit more distrust among the sellers. We're not totally there yet, but we're seeing that. So what that means is that there's a lot of good value points to purchase fix and flip assets. And we're doing that as well. We're doing that very aggressively because the entry level properties are moving in this environment. Now, the next thing that we're doing, and then you as an investor have got to be very cognizant of this. The fourth thing that we're doing that you need to think about doing is you need to think about investing in real estate funds. And so I'll go over 2 types of funds. Number one, we're starting to see a creation of distressed asset funds that are out there. And so we're seeing a lot of people on Wall Street putting together gobs and gobs of money to get ready to buy either distressed mortgages, whether it's first trusts. I'm seeing pools for distressed second trusts that they're building. I'm seeing pools for commercial assets, whether it be industrial, retail, medical. We're seeing those types of distressed asset funds being created as we speak. So that's a good way to sort of think about maybe putting your money. But for us, though, a great way to put your money is in these things called the pooled mortgage funds. What is a pooled mortgage fund? Well, that is a fund that invests in a pool of mortgages. We have 2 funds on the hard money side. We have a 506B and a 506C fund. And so basically these funds are investing in our hard money loan business. Now, most of the cash in our hard money loan business is our own cash, but we do have funds. We have a C fund and a B fund, where our lightning fund is the 506C fund, which is open to accredited investors. Now, what you guys need to do is talk to your investment advisor about, into these different kinds of investment strategies, because these are not for novices. You've got to be well educated and talk to your investment advisor about doing it. We've had investors in our funds. We have paid 78 straight interest payments to our investors. So you guys are more than welcome to be part of our funds. Look into it, talk to your investment advisor. Now, the fifth thing, and probably the most important thing that you need to do during a recession, is cash is king. And so liquidity is very, very important. And so what you guys should be doing is you should be keeping track of your liquidity quotient every month, every quarter, every year. Remember, cash is king, because you never know when a good deal might come come around, and you might have to close that deal 7 days, 14 days. I've had deals where we've had to close in less than 24 hours. As long as the title's been pulled, we've been able to close deals in less than 24 hours. So the key to us is, number one, cash is king. Number two, you've got to have certain bank relationships, and the bank relationship could be as simple as having a HELOC, home equity line of credit, that has a lot of availability on it. But again, cash is king. You've got to be liquid, because we don't know when the bottom is going to happen in this market. And so if you're buying close to the bottom, you're buying at the bottom, and you're buying as we're ramping up to another part of the marketplace, then you're going to be buying close to the bottom as you can. So cash is king, and you've got to do liquidity. Now, the next slide that we're going to talk about is our financial roadmap, and I'll turn it over to Sam and let him talk about that.
So the roadmap to wealth that we have laid out is one that Clear Sky has put together. It leads through an entire process from novice to expert, and we consider this to be moving from surviving to thriving. You go from surviving to planning to thriving. And that's what we were getting at with our earlier poll, to try to understand where people who are attending this are, so we can gauge the rollout of our educational platform. So looking at what comprises these different groups of people, we're thinking about surviving. If you're in a mode right now, which this is about equally distributed according to our poll of attendees, we have a couple hundred people on here today. We have people who are looking to earn and learn right now. They need to generate cash, and this could be a good opportunity for them to do their first flip. It is going to take careful evaluation to make sure that they're finding the right opportunity, and then beyond that, if they're planning how they're going to manage a bigger portfolio and take a net worth that's small and grow it, they're going to do that in the planning mode. So you can think in terms of, it's a couple of years in their survival mode, it's a few more years in the planning mode, and then you get to a thriving mode where you're focused on maximizing your residual income and the equity that you have in all of your assets. So if you're looking at that across the roadmap, we'll look at the next slide and see that we start with an educational basis. And on the education, we're going to have to learn all about real estate. We're going to need to know where who we reach out to for all aspects of the transaction, from closing to fixing to selling. How are we going to manage it? How to read basic statements that you get at closings, like a HUD, things like that, or a Alta. Then after that, we really need to start understanding where we're going to get our leads. So in lead generation, you have a couple of different ways you can get it. You can go out and source them yourself. Charlie's extremely effective at doing that. We have a broad network of people, so we're out generating leads for ourselves all the time. But we're also thinking in terms of wholesaler. Even today, we're closing on a deal that was brought to us by a wholesaler in Maryland. And it's very nice and very attractive, very quick fix and flip opportunity. A family estate needed to liquidate a house. So the wholesaler is going to make some money, and we're going to have a house to flip. At the same time, if we find a lead that we're not interested in pursuing because the scope of work is something that we're not ready to take on right now, whether it's small or large or whatever, then we could wholesale that to someone else. So there's an interplay between wholesaling and lead generation. You have to understand, when you go a little further down the path, you're going to need to close the loan, close the purchase with a loan. If you don't have cash, you're going to have to close it with a loan. That's where you might look to a hard money lender, or an active one in the market like Clear Sky Financial. We're out there, and you'll become educated about what the cost structure is for that, how the payments work, how you get advances on construction loans, and so forth. And then once you've done that, if you're going to retain it and keep it as a residual income asset, you need to learn how to manage property. It's not, I got a call yesterday from a good friend of mine who has a few rental properties. He had a holdover tenant. Some people moved out, left a tenant. He didn't know how to manage that. So we had to discuss that. So there's a whole component of property management that once you understand it, go back to the educational part, then you can execute on it, and it works pretty smoothly. So one thing you do want to be aware of is you don't want to try to catch the market and predict where it's going to be exactly. It's like trying to catch a falling knife. It's a way to think of it. So you need to find opportunities that are unique. Even within a market that's down 10%, that's not going to be enough to cut it for finding a good buy. gonna have to go out and find something that's a great buy, maybe that's 40% discount to the market. Those deals are out there, and we can help you find them and evaluate them. So there are a lot of questions, I think, percolating out there. We have a few minutes left on the seminar. We could go 5 minutes of questions. Sandra, what do you have folks coming up with?
I want to thank you guys for
Yeah,
attending.
so we did have
Sorry.
So let's answer a few questions first. We're going to actually, talk about Sam and Charlie, and you guys can get in contact with them. Their information is available in the slides that we have available that I put online. I did not want to go that far. That we have online. Can you hear me okay?
Yeah.
Yeah.
Okay, so we have a question about, are you finding your rentals on the market or off the market? And do you or would you buy a rental that is already occupied? Very specific question.
So the answer to your question is yes. Now, let me caveat that. The way that we're finding our properties is this thing called, well, there's two ways. The first way that we're finding it is under the distressed asset space, whether it's a pre-foreclosure, foreclosure, out of town person who owns a property. That's one of the ways that we're finding our properties. And so we're also finding them via the hidden market. The hidden market is defined as properties that are not for sale, but that are really for sale. So I have a lot of different people bringing me leads, whether it's wholesalers or realtors or different kinds of folks like that. And so that's one of the ways we're doing it. Now, if I were to buy an already occupied property, it's going to have to meet our rule of 1%. If it doesn't meet the 1% or 100 times rents rules, then I doubt we'll buy it. If they're not willing to sell at a certain price, then I don't know that we'll even buy it. A lot of times what's going on is that the actual property value in the marketplace is a little bit more expensive than the rents. And so what we found out with occupied properties, buying them from existing landlords, is that it simply just doesn't cash flow. But if there was a scenario that does cash flow, we'll certainly go ahead and buy it. Thank you. That was a good question.
All right, we're a couple minutes over time, but since we started late, I'm going to give a couple more questions here. Should we prepare for ARV prices to go down, even if it's 6%? And when do you expect it?
Okay, that's another good question. Yes, the answer is yes. We do expect the after repair value prices to come down eventually. They are coming down in the higher market segmentation. They're already coming down. Now, the next thing that's not happening is that they are not coming down in the entry-level property segmentation. And that's twofold, right? Number one, interest rates are still low. And number two, people are still trying to buy because that interest rates are still low. What we're doing is that and everything is based at the subdevelopment level. So you have this macro marketplace called the DMV, but then you have this micro marketplace called the subdevelopment. So any and every kind of analysis has got to be done at the micro marketplace level, which is called the subdevelopment. Now, if you have a certain subdevelopment, like let's say in Virginia, you have Dale City, Rumsco Woods, Rumsco Hills, or you have something in Washington, D.C., Petworth, Columbia Heights, you've got to keep it at that level. Now, with that said, is if you have a subdevelopment and you look everything up and you have, let's say, 6 actives and 6 solds and no under contracts, well, that tells me that right now, current day, that subdevelopment is under price pressure and there's going to be a depreciation. Now, if I have other subdevelopments where I have, let's say, 5 under contracts, 6 solds, and no active or 1 active, well, that's indicative of an appreciating market. Those prices might still be going up. And so that's a very stable subdivision. Now, if I have another subdevelopment that has 3 actives, 4 under contracts, 4 or 5 solds, well, that to me tells me that's a normal marketplace and those properties are moving normally. I'm not going to discount the ARV. So it just depends. But that's another good question. Thank you.
All right, we have quite a Yeah, we have quite a few questions actually on the roadmap to real estate investing. I think you guys need to either have another session on the whole roadmap and how do you go from, the education to lead generation to, residual income flipping and fixing. So quite a few on those. We'll get to you guys. probably in a email directly from Sam or Charlie. Let's see. Do you invest a lot of questions about investing in the DMV area, or do you invest outside of the DMV, like North Carolina, other states?
That's again another good question. The answer is yes and no. Yes, on the hard money side, we have a bunch of loans down there, Raleigh, Wilmington, North Carolina, Chapel Hill, Durham, those kinds of areas. We're not very familiar with it. So the majority of our investments, if not, I would say 98% of them, are in the DMV. What we do is we put a finger on a piece of paper, we draw a circle around it. If we can get there within 2.5 hours non-traffic, we'll do it. But we chose to not expand out of the DMV. We chose to dig a deeper hole within the DMV so that we could be closer to our investments, because what you guys have to understand, it's a lot of work to manage our rentals. It's a lot of work to manage our loans. And so if Sam or myself have to go and look at a loan project, draw schedule, if I have to go look at a rental, we have got to be able to get there really, really quick within a day's time, and we got to address it right away. So the answer is, yeah, we're primarily in the DMV. We have a couple things down in North Carolina, Hampton Roads, Richmond area. We're not really down there yet. We might go down there, but we're not excited about it. Good question.
One of our attendees is texting me directly. He's asking, what do you think about the spring market? So we've had a very, very unusual spring market this year, right? Got off to a little bit of a nice start, sort of a traditional spring market, and then it very quickly collapsed into this COVID environment where the only assets that seem to be selling are vacant assets, or ones that are really executing with a 3D tour and a lot of extra effort on behalf of the agents to coordinate tours where no one is home. So it's been quite a different market. I think there could be sort of a traditional spring market as this COVID constraints they start to lift. So we might see behaviors in August that you would otherwise anticipate in April.
Yeah, that's a great response too. The other thing that is not going to happen is people that normally take vacations in July and August. I mean, you're going to have some folks taking vacations, but I don't think you're going to have that many people taking vacations. And that was one of the big reasons why July and August were normally slow. The other thing that's happening that you guys have to understand is that we're also in a presidential election year. So typically what happens in a presidential election year is that interest rates remain low. Check, that's definitely going to happen. But buyers do not buy houses between August and January because there's a new administration change, if there is one. So people get a little bit nervous around election time as well. So this is a very curious time, and that the only thing we can suggest to you guys is just keep your ear on the railroad track, because these things are changing daily. It used to change every month, every quarter. You could be confident, but you've got to keep your ear on the railroad tracks because things are changing daily and weekly and monthly. This is a little bit bizarre, but it's okay. Just keep an eye, keep abreast of what's going on.
Thank you, everybody, for joining us today. This has been a great learning for us too, to see the audience that we're getting, and we look forward to getting out in front of you with more of our educational program.
All right, so in conclusion, we'd like to thank Charlie and Sam for the information session.
Appreciate
Sam
it.
and Charlie can be reached at the email addresses provided in the handout. Someone asked about the handouts. The handouts are available in the handout section of the GoToWebinar. You should see a PDF file that has the actual slide deck that is available. We will also make it available on the Clear Sky Financial website in the survey message that you get after this webinar ends. We also would like for you to complete the survey. And if you have any questions, you can pose those survey, or you can send email directly to Sam and Charlie. For the questions that we did not get to that came in through the question board, we will have Sam and Charlie pull those together and either make a FAQ or send them back to you directly. Thank you all, and have a great rest of your day.
Thank you, and stay safe.